What does deflation indicate in a current inflation report? Imagine looking at a report that shows prices of goods and services are actually falling. That's what deflation in an inflation report means. It's the opposite of inflation, where prices go up. When prices drop, consumers and businesses are paying less for things than they did before. In reading inflation reports, deflation signals a few important things about the economy. First, it often shows that people expect prices to stay lower or even fall further. This can happen after a period of rising prices, as people think the trend will reverse. It's like a price correction, where the overall cost of goods and services moves back toward lower levels. Sometimes, deflation can be a sign that the economy might be slowing down. When prices fall, consumers might hold off on buying because they expect prices to drop even more later. This can reduce overall demand, which can slow economic growth. If people think prices will keep falling, they might delay big purchases like cars or appliances. On the other hand, some analysts see deflation as a sign that the economy is stabilizing after a period of inflation. If prices are coming down from high levels, it can mean that inflation is easing and the economy might be returning to a healthier state. This is why some surveys find that people expecting deflation also believe the economy will improve. Central banks pay close attention to deflation because it can cause problems. When prices fall for a long time, businesses earn less money, which can lead to layoffs. Also, falling prices increase the real value of debt, making it harder for borrowers to pay back what they owe. This can slow down economic activity even more. Inflation reports, like those that include the Personal Consumption Expenditures Price Index, show deflation when the index drops below zero or shows negative changes over time. This means the average prices paid by consumers for goods and services are decreasing. So, when you see deflation in a report, it indicates that overall prices are declining. It can suggest expectations of lower future prices and economic slowdown, but it can also mean things are stabilizing after inflation. It's a key signal for policymakers and investors to watch closely to understand what might happen next in the economy.